So we talk about technical analysis tools, and today we will be talking about the moving average convergence divergence. Um, the you know mean reversion theory that we talked about is most prominent in um, moving averages. So let's actually draw the our favorite say 50-day simple moving average, and let's actually make sure that it is 50 days. And I'm just going to make it green just to be consistent with our previous discussions, right? Just to make sure that I have everything correct. Yes. So the idea now is that um, with the moving average convergence divergence, we literally looking at how much compliance we have with the mean reversion, right? Because the idea is that prices will revert to their mean eventually. And you can see how this actually have been the case for the S&P 500 index. So for the past couple of years, notice how the prices oscillate around that 50-day, and whenever it actually continues to go up, it seems to have episodes of reverting to their mean. So the idea is how much do we revert and how much do we converge is the basis for moving average convergence divergence, or MACD technical tool. Um, it is important to understand that the technical analysis does not really give you a signal, even though that people seem to believe that these signals are prominent and they mean to buy or to sell. However, they usually just signals to point out if a stock is overbought or oversold, and if a stock is overbought, it may be harder to continue going up, and it may be easier to come down. If a stock is oversold, it may be harder to go down, and it may be easier to go up. But nonetheless, if a stock is overbought, does not mean that it will actually just stop being overbought or stop being high or going high. And notice right here, for instance, we are literally divergent from that 50-day, and we stay that way for a few months. And then we have a correction, but then we actually go back up again. We have a correction, up again, correction, up again. And this continues a little over a year. And then, coming back down, we have that oscillation again. We actually overextend downward and go back up, overextend downward, and go back up, and so on and so forth. So let's take a look at the actual technical tool, moving average convergence divergence, or MACD in short. So the MACD is actually calculated by subtracting the 26-day period exponential moving average from the 12-day moving average. So that's your MACD line, right? So notice in the MACD, we have two lines. One of them is blue and the other one is orange. So let's take a look what's what. On the trading view, they actually have this default that seems to be very common for everyone for the MACD, and that the slow length is 26 days and the fast length is 12 days. So, like we said, MACD, the actual technical tool indicator line, is calculated by subtracting the 26 period exponential moving average from the 12-day period moving average, also exponential moving average. So let's see, you see the EMA, exponential moving average, and MACD line is the blue line. And then we have a signal line, which is the orange right here, and that's the 9 days of the exponential moving average. So we have two lines. One is the difference between the 26 days minus 12 days of exponential moving average, and that's your MACD. And then the orange line is the 9 days. right, of exponential moving average. So whenever the blue line, the MACD line, is actually crosses above the, whenever the blue line crosses above that um, 9-day exponential average, or the signal line, then it usually means it's overbought, right? So perhaps we should look at it a little bit more, a little bit bigger. So keep in mind that this is a very simple tool that's based on moving averages per se. So when we have in the actual price line, when the price is above that 50-day, you actually overextend that. And then right around here, you are overbought. So notice though that with the MACD, we're pretty much the same in that when the price actually breaches above that 50-day, I mean, obviously I chose 50-day here, and this is a different frequency, 26 days, 12 days, and also the 9 days. However, basically, they are looking at the moving averages. And even though the moving averages can be, the frequency can be a little bit different, and even though the MACD is on the exponential moving average, and I'm just looking at the 50-day moving average, but the bottom line is you're looking at how much the shorter perspective of investors or traders change compared to a little bit longer perspective of investors. So if we perceive that the shorter perspective of investors and traders are changing positively, we usually refer to that as a buying signal. And if you perceive that the short-term perception of investors and traders is on the downside, then we usually, compared to the longer term, usually consider that to be a sell. However, like I said, I personally wouldn't go with a buy signal or a sell signal as a robotic technical signal, except right here. Notice how the blue line, the MACD line, 26 days minus the 12 days, breaches above that 9-day exponential moving average, and that's usually considered to be a buy signal. And in our 50-day, we actually see that it's a divergence from that 50-day, and therefore we usually refer to that as a overbought. And we have very similar charts, even with a simplistic 50-day moving average. So I'm not 100% certain the additive value of an MACD. However, you need to know it. It's very popular. People always ask about it, and financial media seems to discuss this quite a bit. So it is nice to know these individual moving average based technical analysis tools. I mean, we discussed about the Bollinger Band. We discussed about MACD now, and so anyhow, so basically what we're looking at is how much of a divergence of price you have from the mean, and how much of a convergence you have of price you have to the mean with the MACD. And I think one of the nice things about MACD is it actually has this signal line in which you can see if the MACD breaks above, you usually consider that to be overbought. And if it actually breaks from top to the bottom, you usually consider that to be a signal of oversold. So let's take a look at a few, and you know what? Let's take a look at more recent and current prices. So right now, for instance, for the S&P 500, we are a little bit oversold. And notice you could actually say that with the 50-day as well. So at the 50-day, notice how overextended we are to the downside, and how the MACD signal line or MACD breaks below the signal line, and therefore we actually have an MACD oversold signal. Let's take a look at a few stocks and then obviously to a currency. So we have a very similar case for Apple and also an MACD oversold signal on Apple as well. Let's take a look at Boeing. I think the price was a little bit different. So with the MACD, even though the MACD line is right above that signal line, I don't think I would consider that to be a signal. However, when you look at the divergence from the the actual 50-day, there seems to be a little bit of an overextension. So I would say that the volume from a 50-day perspective is oversold, but from an MACD perspective is right at that signal line. So I wouldn't say that I would say that there is no MACD signal. Let's take a look at a couple more. As is usual, let's take a look at Disney. It has been going down a little bit, but and again, notice we have the very similar to Apple and the S&P 500 that with a 50-day, it's oversold. With an MACD, you have an oversold signal right there. When the MACD actually breaks below that signal. Take a look at a few more. JP Morgan Chase, oversold on a 50-day, oversold signal on the MACD. Let's take a look at Intel. Friday was actually quite positive. It went up about 10%. But notice, in a 50-day, it's a nice snapback, the mean reversion at its best. So you have an overextension down on the Intel that was simply oversold, and there was earnings, and earnings evidently came back good or as expected or better than the market's expectations. And there was a huge snapback to the mean, and notice it actually just closed at the mean. So I think a textbook example of how mean reversion at its finest that happens on a simple earnings announcement, and even on a day that when the market was breaking down, look at 12% down, and look at how the price actually snaps back for Intel. And even though we have an oversold signal for the MACD for Intel, it seems like it is actually reverting back. However, it still is oversold based on the MACD. I didn't talk about Ford. Let's take a look at that one. Notice how we had an earnings and it was bad, and the price actually just sagged significantly, diverted from the mean, and therefore, this probably is a little bit of an overreaction. Although, come next week, we'll probably see if we'll have some sort of a correction or if the average will actually start to sag down. And notice immediately that in the MACD, there's a kink right here that shows that it was oversold to begin with, but it is now a little bit more oversold based on that. Let's take a look at the dollar euro. So with the dollar euro, the exchange rate, right? So this is how many dollars we pay for the euro, for a single euro. The exchange rate is a little bit oversold on the 50-day. When you look at the MACD, it's actually overbought. So in the little bit longer term, I think, this probably would be a very interesting case, as the simple 50-day kind of disagrees with the MACD, but you actually have an overbought signal on the MACD while you have an overbought signal on the 50-day. So that's the MACD. Thank you so much for working with me. If you have any questions, please let me know. And thank you so much. Bye now.